Marcus is 41 years old. He's a structural engineer in Columbus, Ohio. And in March of 2020, he did the single most expensive thing he's ever done in his life. He sold everything, every share, every ETF, his entire brokerage account, about $74,000 worth of equity he'd spent 9 years building, gone in 3 clicks. And the reason he sold? Because every single person around him was selling too. The news was screaming. His co-workers were panicking. His brother-in-law texted him a chart that looked like a cliff, and his gut, that ancient primal survival-wired gut, said, "Get out. Get out now." So he did. Here's the thing. Between March 23rd and December 31st of 2020, that's 9 months, the S&P 500 gained 67.9%. Marcus watched it happen from the sidelines. He'd locked in his losses and missed every dollar of the recovery. He didn't lose money because he was dumb. Marcus has a master's degree. He builds bridges for a living. He lost money because he was human. And that distinction matters more than almost anything else in investing. Now, I've been Marcus. Let me be honest with you. In 2011, I was 29 years old. I had about $18,000 in a brokerage account, and Europe was melting down. Greece, Italy. The euro looked like it might crack apart, and I pulled $14,000 out of equities and put it in a savings account earning 0.4% annually. I felt smart, cautious, rational. I sat in that savings account for almost 2 years. The market returned 32% over those 24 months. I earned $112 in interest. That gap, that $4,400 gap between what I got and what I left on the table, wasn't the result of bad analysis. It was the result of perfect, textbook, primal fear. My brain did exactly what 200,000 years of evolution designed it to do. It protected me from the tiger. Except the tiger wasn't real. That's the reframe I want you to sit with for a second. Your brain doesn't know the difference between a market crash and a predator in the bushes. The same alarm system fires. The same cortisol floods your body. The same command screams, "Run!" And in the wild, running saves your life. In a brokerage account, running destroys it. Okay, so here's where it gets interesting. There's a man named Sir John Templeton. In September of 1939, the day World War II broke out, he borrowed $10,000 and bought 100 shares of every single stock trading below $1 on the New York Stock Exchange. That included 34 companies that were in bankruptcy. Think about that for a second. The world was literally at war. The news was as bad as news gets, and this man was buying. 4 years later, he'd turned that $10,000 into $40,000. That's a 300% return during one of the most terrifying periods in modern history. Not because he had better data, not because he had a secret formula, because he understood one thing that most people never do. The price of an asset and the value of an asset are two completely different things. Price is what the crowd decides in a panic. Value is what the business actually produces over time. When fear drives the crowd, price collapses. Value doesn't. That gap between them is where contrarian investors live. But here's the part nobody tells you. Contrarian investing isn't about being a rebel. It's not about betting against everything just to be different. That's not a strategy. That's a personality disorder. Real contrarian investing is quieter than that. It's about recognizing 2 specific moments: when fear has pushed price far below value and when greed has pushed price far above it. That's it. Those are the only 2 moments that matter. And both of them feel horrible in real time. That's the whole trick. When price is below value, the news is terrible, your friends are scared, and your gut is screaming sell. When price is above value, everyone's excited. Your coworker is bragging about returns at lunch, and your gut is screaming buy more. Your instincts are inverted almost perfectly. Now, what most people don't realize is that this isn't random. This pattern repeats. According to Dalbar's 2023 quantitative analysis of investor behavior, the average equity fund investor earned 6.81% annually over the last 30 years. The S&P 500 returned 10.65% over the same period. That 3.84% gap isn't fees. It isn't bad fund selection. It's behavior. It's people buying high and selling low over and over because their emotions told them to. 3.84% per year sounds small. On $100,000 over 30 years, that gap is the difference between $748,000 and $1.9 million, not even close. So what do you actually do with this? Here's the framework I've landed on after years of getting it wrong. I call it the discomfort audit. Every time I feel strong emotion about a market move, either fear or excitement, I stop and ask myself one question. Is this emotion giving me information, or is it just noise? Specifically, I ask, have the underlying businesses I own changed? Not the price, the business. Are they still producing real goods and services that people need? Are their earnings still intact over a 3 to 5 year horizon? If the answer is yes, if the business is fine and only the price has moved, then the emotion is noise. And noise is not a reason to sell. I write it down, literally. I open a notes app and I type out why I want to sell or why I want to buy, and I read it back 48 hours later. Wild, right? It sounds almost too simple. But that 48-hour gap has saved me from at least 4 decisions I would have deeply regretted. Now, if you're someone who earns a steady paycheck, you check your portfolio when markets move, and you feel that sick drop in your stomach during a downturn. This framework is specifically for you, not for day traders, not for people trying to time markets professionally. For the person who's building something slowly, steadily, over years, and keeps accidentally getting in their own way. If that's you, you already have the most important ingredient, time. You just need to stop letting fear eat it. The most expensive thing Marcus ever did wasn't selling in March of 2020. The most expensive thing was the story he told himself about why it was the smart move. Because once you build a narrative around a bad decision, you defend it. You wait for the market to crash again so you can say you were right. And while you're waiting, the compounding keeps running, just not for you. Tonight, before you go to sleep, open your brokerage account. Don't buy anything. Don't sell anything. Just look at your longest held position and ask yourself, if this thing dropped 30% tomorrow and the business itself hadn't changed, would I add to it or would I run? Your answer tells you everything about where you actually are as an investor. The contrarian edge isn't a secret formula. It's the willingness to feel wrong, look wrong, and be patient enough to let time prove the crowd was panicking and you were thinking.